TikTok is full of tax advice for business owners. Some of it is decent. I would say the vast majority is completely trash. I'm an IRS enrolled agent. I have a tax practice, and I'm also a CFP professional. I run an investment advisory firm. And today I decided that I would painfully watch real TikTok videos about tax strategies and rate them from S tier all the way to F tier. Let's see how bad this gets.
Now, when I interviewed you out in Los Angeles, you were in a Ferrari.
Yes.
I know you got the G-Wagon. Are they here today?
Yeah, those are outside.
Could we go take a look at them? Now, what's crazy is most people look at cars like this as they call it like the depreciating assets. How do you feel about that perspective?
Cars are depreciating assets. I 100% agree with them, but I also took 100% bonus depreciation on this car, which saved me, I don't know, about $92,000 in taxes. That $92,000 got reinvested into a multifamily property in Texas. That's paying me cash flow of about $1,400 a month. So if you're somebody that knows how to do math, you can buy a vehicle like this, offset your taxes, reinvest the tax savings into a cash flow producing asset, and not worry about the fact that this car is still losing value sitting here in the driveway because it losing value offsetted my taxes.
So sometimes Carlton Dennis gets a little bit of hate online for being a tax guru, but I think this is one of those videos where he's 100% accurate. I think bonus depreciation is an amazing strategy. At some point, you just can't continue to buy assets every single year. And when you stop doing that, this strategy unfortunately goes away. I think it's a great strategy for businesses that are actively reinvesting back into their businesses. Last point here is just don't buy a car you don't need to lower your tax bill. All right, for bonus depreciation and 179, I'm going to rate this an 8 tier.
$1,000 leveraging tax strategies. With day 2, I'm going to teach you the Augusta rule. Leveraging the Augusta rule is a lot better than just taking a home office deduction. Why only write off a room in your home when you can write off your entire house? By leveraging code section 280A, the IRS will allow for you to rent your house to your business for 14 days. I have clients that are charging anywhere from $1,000 a day upwards to $3,000 a day, depending on the residence that they're in. If you're looking to leverage this tax strategy, I want you to lock in with me for the Tax-Free Wealth Challenge that's kicking off March 18th. Until then, I will see you on day 3, so be sure to subscribe.
The Augusta rule is 100% real. It's in the code. You can absolutely use it. You rent your home to your business up to 14 days out of the year, and all that income that you report is completely tax-free while your business gets the 100% deduction. The problem is when people start charging $1,000 to $3,000 per day, like in the video. Unless, I would say, here's my opinions, unless you can prove with market data that your home actually can pull those comps. You can pull comparables on PeerSpace or Airbnb. You can use VRBO. You can use any other Zillow numbers, for example. And sometimes I feel like those numbers that a lot of these gurus post they're very inflated. And sometimes I feel like you're begging for an audit. So I would say for the Augusta, use it. Just be honest about the rental pricing. So for the Augusta rule, we're going to go for the B tier just because sometimes the strategy can be completely abused, but when you use it properly, it can be a great tax savings mechanism. All right, let's go to the next video.
Taxes if you're a high W-2 income earner. The obvious is to max out your 401k. I wouldn't be a tax strategist if I didn't tell you to do that. But the second thing you should be focused on every single year is acquiring one short-term rental property. If you can acquire one short-term rental property and rent the property on average 7 days or less per customer, you can activate losses on the tax return. So now we should end up performing what's called a cost segregation study. This is the strategy you're going to use once you acquire the short-term rental. And this is going to give you anywhere between 20 to 30% of your purchase price as a year 1 tax write-off. So let me give you an example. If I buy an investment property, one short-term rental at $500,000, I'm getting 20%, so that's $100,000 in year 1 depreciation. If I'm earning $100,000 as a W-2 taxpayer and I have a $100,000 loss, I'm paying 0 taxes. And this is why W-2 taxpayers should focus on short-term rentals in combination with their retirement.
This is the cost segregation / short-term rental loophole strategy. I absolutely love this strategy. I personally use it myself. myself and for a lot of my clients, the strategy is that you buy a short-term rental, run a cost segregation study, and then generate a massive paper loss that can actually offset a lot of your other income. It's one of the very few ways that a W-2 earner, sometimes a high W-2 earner, can create real estate losses without being the real estate professional. But here's the big but. People gloss over, I think, the biggest detail. Your average guest stay has to be under 7 days or less. And the second one that's really hard to, I would say, fulfill is the material participation rules. There's 7 rules of material participation. We're not going to go over that in this video. But if you miss those 2, those losses are converted back to passive and are locked up until you sell the property. So I think, again, this is an amazing strategy, but you have to follow the rules. All right, so the cost segregation in combination with the short-term rental is an absolute S tier when you follow the rules. It's completely legit, has huge tax savings. You just have to make sure that you follow the guidelines.
Why on earth does the IRS pay you to pay your kids and reduce your taxes? I don't know, but I just report it. Let's break it down. I've seen a lot of different videos that tell you to put your kids on your payroll if you own a business. However, they don't actually tell you the whole behind the scenes of why and what it actually amounts to. Let's say you have 3 kids. Johnny, you can have him stuff envelopes. Susie could be working on the computer. And the third one, well, he or she can be doing whatever, answering the phones. You can pay them a maximum amount of $12,000 a year. This is for 2022, and it is tax-free. But here's the bonus. Number 1, you pay them $12,000 and they don't have to pay taxes on it. Number 2, you get to remove that amount. So let's say you have $12,000, you have 3 kids, that's $36,000 that reduces your business taxable income. The business gets to take a deduction, your kids get that money tax-free, but there's one more. You can actually put $6,000 into an IRA too.
So kids on payroll, this is 100% legit strategy. You can hire your kids, pay them up to the standard deduction, then pay 0 federal income tax on that money. But here's what gets left out. You can't pay, for example, $12,000 to a 3-year-old, right? The IRS requires that the work is real and the pay is reasonable based on fair market value. I would always tell my clients is like, could you hire someone off the street to do that same job at the same rate? I would say that's the internal test you have to ask yourself. I would say your entity type matters as well. Are you a sole proprietor, single member LLC? You can skip payroll taxes if they're under the age of 18. If you're an S corporation, you don't get that same benefit. So the strategy works, just make sure the details actually hold up. So for kids on payroll, I'm going to go ahead and add this as a B tier because it's a great strategy. However, I think a lot of people inflate the numbers for their kids and pay them whatever they want. So they have to make sure that they follow the rules and pay their kids a fair market value.
Did you know that you could potentially write off your dog on your taxes? You can depreciate them over 7 years or take a Section 179 write-off. However, they have to be used for business. Guard dogs, breeding, farm dogs. Now, I like to think that you could be a guard dog, but something tells me these little paws ain't getting too far. As always, John's Finance Tips.
Can you write off your dog for tax purposes? Okay, I'm going to be a little real here. I think this is a dumb one. I actually had a quick story. I had a client that came to me a while back with this whole elaborate story about why their dog is a business expense. And I think it was like $500 a year or something like that. And I'm sitting there like, okay, if you want to die on this hill for $500, go for it. But I feel like so many people spend so much energy and time trying to justify something that is not really even going to save them that much in taxes. To their defense, are there legitimate cases where people can write off their dog? Absolutely. Like the video said, if you're a farmer and you have working dogs, or the other scenario where I see where this can make sense is you have some sort of warehouse where you need a guard dog, that's 100% ordinary and necessary. But if your golden retriever is sitting in the corner of your home office, that's not a business expense. So I would say don't do this one unless you can really justify it. So for deducting your dog on your taxes, I'm going to go with a D tier. I think the vast majority of people can't do this. I think there's a vast minority of people who can actually write off their dog. And if they can, I think the deductions are not material whatsoever.
In order to use it every single year, you have to understand the rules. The very first thing that I'm going to need you to understand is you're going to need to buy an investment property.
So really quick, I'm reacting to someone else reacting. So it's react Inception.
You buy a rental property, it could be an Airbnb or it can be a long-term rental. But as soon as you purchase the property, I want you to write off everything that's on the inside of the property. This could be appliances, bathrooms, tubs. And when you write off everything that's inside of the property, it creates a big expense. We call this the cost segregation study. Once you do the cost segregation study, it creates a big enough loss to offset your W-2, your 1099, your stock, and your crypto income, making you tax-free.
I absolutely love this strategy, but there's something important to note. If you want to offset your W-2 income with passive activity losses, you need to make sure you qualify under one of two exceptions. Either you're a real estate professional in the eyes of the IRS, or the average stay in your properties are 7 days or less.
All right, so this is kind of funny. I'm watching Edward Collins react to Carlton Dennis. By the way, Edward is 100% correct on this one. If you want to use a cost segregation losses against your active income, you either need to qualify as a real estate professional or use the short-term rental loophole, which he's talking about those 7 average days or less. So there's a lot of complexity on this one, so just make sure you know the rules. But the theme overall is this is 100% correct. So for the cost segregation study paired with either the short-term rental or the real estate professional status, I'm going to go with an A or S. I'm just going to keep it with an A because he added the real estate professional status, which has a lot of rules to it. So you can look that up. I would say this is probably an A tier strategy.
So guess what? You're going to need these 5 things in order for that deduction to stick. Most receipts have 3 of them, but there are 2 things that you need to manually do. And God forbid if you ever get audited and you don't have these 2 things, guess what? They won't be valid deductions, and most likely you'll be sending money back to the IRS. Here they are. The 5 P's to a proper tax deduction. Number 1, place, where you actually purchased the item. Number 2, point in time. Make sure that you have the date of when the purchase actually took place. Number 3, the purchase amount and what you actually purchased. So here's the 2 that most people miss. If you're going to go out to a restaurant and you want to take advantage of the 100% meal deduction, you need to make sure you have these 2 key pieces: person and purpose. If you don't have who you actually went to dinner with and what the purpose of that meeting was, it is not going to be a valid deduction. Make sure you have all 5, and should you ever need to send in proof, you've got everything you need.
All right, so this video is essentially talking about deducting meals from what I gathered. So quick note, I believe back in 2022, business meals were 100% deductible. That was under a specific COVID provision. It's gone now. So now we're back to 50% deduction. If you're going to expense business meals, I would say just be honest about it. I know it's crazy to say that. Are most people honest? Probably not. But try to be as honest as possible. So as someone who prepares tax returns every single year, let me give you guys a little glimpse into what actually happens. It's a complete cluster of personal versus business during tax prep. It gets lumped into one account, and then the bookkeeper and tax preparer has to figure out what's personal versus business. If you're a business owner, just try to segregate those 2. So I think people overthink this and blow it completely out of proportion. It's 50% of a dinner. It's not this huge game-changing tax strategy. So for business meals, I'm going to go with C tier, and let me explain why. I think absolutely you can use this as a business expense, but I think people blow this out of proportion and try to romanticize just deducting every single meal. I don't think that's accurate.
You give me the next 45 seconds, I'm going to make it super easy to understand. Let's say you're a nurse in a hospital and you make $80,000 a year. Taxes come out of your paycheck automatically, so when the money hits your bank account, you've already paid your taxes. But when you own a business that makes $80,000 a year, that is not the case. Every dollar you make goes straight into the bank account before you've paid taxes on it. And not all of that money is for you to keep. First, you have to pay your business expenses, like the rent for your office building, advertising fees, and the salary that you pay your employees. And after paying all of your expenses, you only have $30,000 left in the bank. So you write off the $50,000 you spent on business expenses and only get taxed on the $30,000 left over. TLDR, when a business pays taxes, it pays them on its net profits after paying all of its expenses.
So I know this is probably not like groundbreaking news for a lot of people watching this. You don't pay taxes on your expenses. You pay taxes on net profit, just like she said, also known as book income. That's just how business works. But let me talk a little bit about something else where I think this actually trips up a lot of business owners, and she didn't mention this. So let's say you make $100,000 in profit, but you only took $20,000 out of the business bank account. You're taxed on that full $100,000, not the 20. So this happens a lot, but this tricks a lot of even established business owners where they think, hey, I only took $20,000. I'm only taxed on that 20. You're taxed on that full $100,000. dollars. So just be careful with that little trick there. All right, so not paying taxes on your expenses strategy. I think this is just like, this is not a strategy. This is just like normal business operations. So I'm going to put this in an F tier.
Write-off, does that mean that the government pays for it? What? It's free. It's free.
Who the hell said that?
TikTok. Just kidding.
A tax write-off is not the government's paying for everything. There's a difference. Okay. A tax credit is something that you receive, a credit. That just say you make money and you have a $20,000 tax bill for the year, right? If you get $1,000 tax credit, right? That means you owe the state, you owe $20,000 to the tax man. That $1,000 is directly reducing that $20,000, so you only owe $19,000. That's a credit. A write-off is different. A write-off is when you spend on an expense.
This is not tax advice.
No, first of all, thank you. This is not tax advice.
All right, does a write-off make it essentially free, or this common misunderstanding? A write-off is not free money. You still paid for that as an expense, as a cash outflow out of your business. The tax savings is based on your effective tax rate. So let's say, for example, you spend $100,000 on new equipment and your effective tax rate is 20%. That means that you effectively save $20,000 in taxes. You're still out $80,000. Now, a tax credit, like he mentioned, reduces your tax liability dollar for dollar. That's where I would say the real power is. I would also say that credits are a lot harder to come by. So just to conclude here, no, write-offs is not free money. It's a discount, not some sort of reimbursement. All right, so is the write-off free money? No, it's not. This is going to go into detail just because it's a misconception.
So just stop right here. Give me a second. We're going to talk about write-offs because this is how you're going to save money on taxes. And we love to save money. This is something really important for you to pay attention to throughout the year so that you can actually save money come tax time. A write-off is basically a business expense, something that you need to have or pay for that is necessary to actually run your business. It offsets the amount of profit you're making because you're spending money, meaning that you're going to owe less in taxes. This is the general rule of thumb. It is anything that is deemed ordinary and necessary for your business. So there's wiggle room because what you consider ordinary and necessary might be different for me. But okay, let's dive into it. Now, here are some examples of, like, for sure, if you're a creator, like, these are going to be expenses, okay? Editing software, your Lightroom, your Photoshop, your camera, maybe you need a prop for a photo shoot. These are all ordinary and necessary to run a creator business. These down here are where it gets a little bit questionable. Clothing for photo shoots, hair, makeup, your beauty appointments, things like that. Are they things that you would not have purchased or not have done if you were not doing your business?
All right, so ordinary and necessary business expenses. She's 100% right. If you're a content creator, small business owner, your camera, software, equipment, those are, I'd say, ordinary and necessary expenses for your business. But then, like she mentioned, you get into this like gray area, like makeup, haircuts, clothing. The vast majority of the accounting industry is really conservative when it comes to that stuff. So let me give everyone watching this video a little bit of a glimpse of what happens in the real world. No tax professional is going to go through your receipts trying to make sure every single transaction is ordinary and necessary. Ain't nobody got time for that. We're taking, for the most part, your word for it. You tell us whether it's a business expense or not, and then we're going to put on the tax return. Now, if you get audited, that's on you. So make sure you're honest about this and make sure it's an actual business expense. All right, so ordinary and necessary, we're going to put this in an A tier because it's underrated, underutilized. Absolutely make sure that all of your expenses are either business or personal.
We are talking about writing off your service animals and your emotional support animals. So if you're a millennial like me and your pets are basically your kids, you're probably wondering, are there any tax benefits that I can claim for my pets? And usually pet expenses can't be written off, but if you have a service animal or an emotional support animal, then you can actually take those expenses as medical expenses and itemize them. So if you were choosing to itemize your deductions instead of taking the standard deduction and you have a service animal or an ESA, then you can write off expenses like the cost of purchasing the animal, any vet visits or vet expenses, cost of food, litter, all of those types of things. These would be considered a medical expense on your itemized deductions.
All right, can you deduct your dog as a medical expense on your Schedule A? So I love dogs. I have 2 of them, but I would say this strategy is pretty dog shit. So first of all, this isn't a business expense. It's a medical expense, which means it goes on your Schedule A as an itemized deduction. And medical expenses on Schedule A are by far the worst deduction in the tax code. You can only deduct the amount that exceeds 7.5% of your AGI, adjusted gross income. So let's say, for example, you make $100,000. The first $7,500 in medical expenses gets zero, nothing. You only start deducting after that 7,500. And on top of that, most people don't even itemize. You're taking the standard deduction unless you live in a high income state tax or you have very high interest on your mortgage. So you're jumping through all these hoops to write off your emotional support dog on a schedule that most people don't even use. So I would say this is an F tier. All right, writing off your dog, absolute dog shit F tier.
Okay, why are all rich people driving Range Rovers? You're broke. Why are you asking? Bro, I'm just kidding. You see, under Section 179, you can write off any vehicle that weighs over 6,000 pounds and is used for business more than 50% of the time. So the Range Rover weighs over 6,000 pounds and the rich buy it through their businesses so that they can write it off as an expense and pay less taxes. Yeah, and you don't just have to buy a Range Rover. It could be a Tesla Model X or a G-Wagon or any of the other cars from this list that qualify for the deduction. I had no idea.
So this is basically the same strategy as the first video we looked at on Section 179 and bonus depreciation. And yeah, this is 100% accurate. A lot of business owners making substantial amount of money will buy vehicles over 6,000 pounds. So it can qualify for Section 179 and or bonus depreciation. That's real. That's 100% legit. Now, again, I always like to give people a glimpse of what happens in reality of someone who prepares tax returns. Most business owners will say they use it 100% for business, even when they really don't. That's just the truth. It's one of those things where on paper they say it's 100%, but in real life, you're picking up your kids, you're going to the grocery store, you're going on a date, whatever. Just know that if you're audited, you better make sure you have the mileage log to back this up. All right, so bonus depreciation and Section 179 on vehicles. We're going to put this in tier A just because it's one of the best strategies out there to accelerate depreciation for a lot of equipment that you buy. All right, so that's the end of the 12 videos. I didn't think they were that bad. I think there's a lot of good videos here. I think some of them, like the dog one, I think that one was hilarious. I think that's completely useless. But overall, I think this was super entertaining. And again, if you're a small business owner and you need more than just tax preparation, but you want tax planning, go ahead and go to the link below. There's a 30-minute free consultation with our team just to see if you're a good fit or not. And I will catch you in the next video.